want to introduce Michael Bailey. Michael is the Director of Research and Chair of the Investment Committee at FBB Capital Markets. They're a boutique DC area investing firm. Michael's stock picking and portfolio management process uses behavioral finance techniques stemming from the work of Daniel Kahneman and Richard Thaler. He's responsible for monitoring and analyzing macro and microeconomic data, secular industry trends, and identifying investments for client portfolios. He was previously a buy-side research analyst with Legg Mason, where he focused on the healthcare industry and managed a healthcare portfolio, while also covering financial and industrial stocks and advised Legg Mason's socially responsible investment group. He was also an equity research analyst with Bear Stearns, where he followed the medical devices industry. His financial insights and analysis have been featured on appearances CNBC, Fox Business, NPR, and Bloomberg Radio, as well as the Wall Street Journal, CNN, Forbes, Barron's, and the Washington Post. He earned his undergrad degree in international studies from Emory University and a master's in international economics and MBA from Johns Hopkins University. He's a fellow CFA charter holder and a member of the CFA Society of Washington, D.C. So with that, I want to welcome Michael. Thank you. See if I'm going to turn that off.
Can you guys hear me okay? Working? Great. Excellent. Well, thanks so much for having me today. So again, the person who's not the tallest one in the room, I think I'm going to just maybe stand over here if that's okay, folks can see me. So really appreciate Ashby organizing the event today, and Ellen and others, so really excited to be here. Great to be in person. I know a lot of virtual events, so it's great to see folks back in focusing on things in person, so it's great. I was putting together a couple thoughts for the talk today and was talking to my kids about it, and they're saying, Dad, where are you going tomorrow? And I said, well, I'm going to a CFA lunch. And I was like, well, like that's pretty awesome. Like, are you going to like Chick-fil-A for lunch? Because I mean, that's great. I'm like, well, sorry to let you down, but no. So I'm excited to be here. But I think along those lines of kind of making an assumption and running with it. Now that is a part of behavioral finance. So we'll kind of get into that. So let me let's see. I think I can advance this. So in terms of today, really appreciate everybody's time. I know we're all busy, so that was the idea, kind of just a quick sort of overview of behavioral finance for busy folks. I know we come from a lot of different backgrounds, whether we're stock pickers or if you're kind of an advisor working on a pension or endowment or other areas, but I think there's a lot of behavioral finance themes that can be relevant, and hopefully there are one or two things that may stick with you from the talk today, and that's something that you can take back to your practice. So we'll get into a little bit of sort of some of the theories. I know with CFA studies, a lot of folks, you've kind of studied this a little bit, but we'll kind of refresh your memory and touch on a couple new themes that are coming out. And we'll go a little bit deeper in one particular case study, GE. Certainly a bit of a roller coaster there, so we'll get into some ups and downs and how behavioral finance could be a different way of looking at something like that. And then we'll start to get into a little bit of for each of us, if we're working at whether it's individual investments or looking at an ETF or an asset class, kind of the whole life cycle of doing your research on something, making that purchase, watching it trade around, and then selling it, and kind of some of the behavioral pitfalls that can happen as you're going through that. And then we'll wrap up and just have some kind of summary and think through different biases and emotions that can impact the market, as well as some of the stuff that we're working on. And by the way, please fire away with questions throughout. We'll definitely have some Q&A at the end, but definitely want to make it interactive. So behavioral finance. I don't know if anyone here is a kind of New York Stock Exchange trader. This is kind of probably the opposite of what a lot of us do. I wanted just to show this as kind of an example of if we think of behavioral finance sort of being calm, cool, collected, thinking through bias and emotions. For a lot of what we do, most likely we're not under the same stress and pressures of certain parts of our industry, whether traders and that sort of thing. There is a lot of emotion, there's a lot of time constraints, they have to rush into decisions. I think for many of us, whether you're in research or you're a portfolio manager or you're an advisor with a client, you do have the ability to kind of sit back, kind of stop and think, evaluate different probabilities, and sort of be careful if you might be jumping into some investment that could be a bad deal. All right, so as we start to get into behavioral finance, I enjoy watching sports. It's a lot of fun. So we just got off March Madness here a few weeks ago, and I thought just in terms of linking what we're doing in finance to the real world, there's some pretty good examples out there. So the two different Coach Ks, we got Bob Knight. Anybody here familiar with Mr. Knight? Seen him coach years ago. And then Coach K, who just retired for Duke. I know certainly probably some lovers and haters of Duke in here. Won't go there yet, but the point here is basically you've got two really successful professionals here who just had incredible careers, a lot of wins, but their approach and style was extremely different. So you've got Bobby Knight over here throwing chairs, punching players. There's an ESPN documentary that's pretty brutal, but he won games. On the other hand, you've got Coach K. Now, he's certainly not a wallflower. He'll get up there and yell and scream, but a lot more calm, cool, collected, strategic. That was his approach to winning, and he had a great track record. So a couple different examples as we think about our careers. You can certainly be successful in different ways, but again, this sort of the Bobby Knight approach, really getting the hothead, throwing the phone, slamming the door. A lot of times those emotions, again, my experience in the readings suggest you can things can snowball, you can get into some trouble. So just want to kind of think through that kind of at a high level. Okay, so we'll go a little bit deeper here into some of these personality types. So I think the question here is a little bit more if you were to maybe put on the hat of your client. So your client, walks into your office, the question is, who do you trust? You're putting a big chunk of your financial assets with somebody. Do you want to put it with Homer Simpson, somebody on the left, person who makes shortcuts, kind of lazy, maybe greedy, that sort of thing, or someone who's a lot more, again, strategic thinking, kind of analytical. So one of the founders of behavioral finance, Richard Thaler, sort of breaks these personalities in two. So humans on the left, and then econs on the right. That's kind of what it refers to them as. It's just the idea of if you were to use all the economic information out there, can you really make better decisions? Again, Mr. Spock, the kind of alter ego to Captain Kirk, who's flying off the handle, and Spock kind of reins him in and tries to make good decisions. Homer Simpson, the opposite. One of the other individuals involved in behavioral finance, kind of creating the field, unfortunately passed away at a young age, but Amos Tversky really focused more on the humans here, natural stupidity, basically mistakes that people make. They're kind of psychologists that dabble in economics, but really they're focusing on a psychological bias is actually an error. So when you're risk averse or you're complacent, you're overconfident, you're actually making an error. And I think that's what he's focusing on there, kind of cutely calling it natural stupidity. Relative to this really high-end kind of artificial intelligence. I think Ashby was saying there's another meeting here in a few weeks talking about AI and quant data and that sort of thing. There's a lot of great research going on there, but again, the focus here is a little bit more on humans and kind of some of the mistakes that we make. All right, so we've talked a little bit about sort of different problems we can get into as far as if we're a hothead or emotional, maybe make a mistake versus being more calm and organize, that sort of thing. So just to get into a little bit more depth, these are the two sort of living founders of the field, really. Daniel Kahneman won a Nobel Prize in 2002. Richard Thaler won a Nobel Prize in 2017. If I could kind of focus the whole talk today into one sentence, it would be here. So this encapsulates a lot of problems that people make across the board. I'm guilty as charged as well. But a lot of times, we're busy, we're rushing around, we're doing things, and we can, instead of really doing our homework and doing all the math and all the analysis, we have an impression, sort of a quick and dirty, this is what I think is happening, and then we believe it. So we believe our impressions, but wait, there's more. Not only that, but we'll have kind of, what's the next step, is you'll have sort of a desire. So, there's a, Tesla stock is running, and we have an impression that Tesla's a great company and a great management team. We believe that, and then we have this desire to act on it, and then we do. We purchase it, maybe at the wrong time. So a few things to think about there. Again, Richard Thaler, he was in the movie version of The Big Short. I'm not sure if anybody saw that, but it was a good movie. One of the things he talks about there is the hot hand fallacy. So in the movie, he talks about this as a behavioral finance kind of issue. And I think the idea here is, if you're watching basketball, I think just watching on TV, you'll see a great player make a bunch of shots. Like, oh, this guy's got the hot hand, he's on a hot streak. And you feel like he's going to make the next shot. Now, sometimes they do. And I think a lot of times you just assume that there's this hot hand. And sometimes it works. But if you, again, sort of think of this Homer Simpson versus Spock, if you do the work, do the analysis, look at the numbers, there's really, the data would suggest there's really no hot hand. So it's, you kind of want it to happen. Again, that's that desire. Oh, this is my team, my player's on a hot streak, he's gonna make the next one. But again, just looking at the analysis, it's a little different. Just one last thing here. So for Kahneman, is a little bit of a personal story. I started reading one of his books, this one right here, Thinking Fast and Slow. I actually got it from a former employer and was reading it, and started putting together a few ideas of, hey, this is kind of theoretical, a little bit of mumbo jumbo, but how can I turn that into something I can use for my practice as an investor? So kind of created this big long list. I'll give you a view of that in a minute. And that snowballed and eventually turned into a book, because I felt like I couldn't just look at a checklist of things that came from one of these guys. I really needed to write it out. So we'll touch on that in a little bit. Okay, so I am going to go a little bit deeper, give a couple of examples in terms of thinking of some shortcuts that we make and problems that we can step into. So impressions. All right, we've got 3 parallel black lines here. Now, who here thinks that the middle black line is the longest? Anybody want to join me on that? I mean, it's obviously, you've got these little things on the side, it's noisy, but I mean, I have an impression. I mean, it looks like the longest, so I think it's probably the longest one. Maybe not. So if you kind of do the work, separate the noise, get out the ruler, draw the dotted lines, it turns out there's a bunch of, again, noise or distraction, but this is kind of an illusion. And so I think this is kind of cute on paper and maybe goes back to like Psychology 101, but in reality, this can happen. I mean, you're opening up the newspaper, everyone says, oh, this company's great, the stock is just running, you got to own it. Wait a minute, that's just an impression. What about the financials? What about the management team? What about competition? So really kind of doing your work before you believe that impression. All right, so the next connecting the dots is acting on our desires. So I don't know if the desserts are here in the other room. I'm sure they're really good. A lot of times as humans, again, we have this built-in desire to kind of do something. Now the desire part's okay. I think the question is the action. So, if someone had this big giant dessert in front of me, I'd be like, oh, I really want that. Am I gonna, eat more than I should, even knowing I'm gonna feel kind of crappy afterwards? But so there's that tension. And I think as an investor, if you're talking to a buddy, oh yeah, we've owned that stock forever, it's a winner. Maybe that's actually towards the end of its life cycle. Maybe that's not the time to be buying it, but you can get that desire. The problem is acting on it. So I think that's something that I've tried to kind of work through and kind of build into the investment process to be just really careful with. Okay, so we talked a lot about kind of behavioral finance, where it comes from. A couple more examples here. I like movies and sports just to kind of bring this stuff back to the real world. So Michael Lewis, again, he also wrote The Big Short, but he's actually done a lot of stuff in this space. So he wrote Moneyball. Anybody seen the movie or read the book? I think it's great. It really does a good job. And I think he really takes kind of an abstract, again, psychology, whatever, of behavioral finance and economics, and shows in the real world what can happen. So in this particular case, you got a bunch of baseball scouts. Traditionally, before there was technology, they would just go out there and get a good feeling. Okay, this guy's got a great arm. This guy's got great potential. I can feel it. And they would go out there and scout for these folks. And sometimes that would work. And unfortunately, in this case, for Oakland A's, it just wasn't working. They were overpaying for these folks. And they brought in a big shot from MIT, this kind of smart guy, and he was able to dig through the analysis and found cheaper players who, on paper, using the numbers, were a better fit, and they were able to do well. And I think that kind of goes back to for investing. You can get in trouble having a feeling. You've invested, you've owned this company for a long time. You've got a good feeling for it. It's made you money. I'm just going to stick with it. Maybe that's complacency. Maybe you should be kind of multitasking, look at some other things, or just strip away the emotion and just look at the numbers. Maybe that's a better approach. All right. So we talked about a couple different things in terms of behavioral finance things that can get you in trouble. To kind of expand that conversation a little bit, I think for those of us in the room, many of us are probably over here, either investors kind of looking at individual investments, could be not necessarily stocks, ETFs, whatever, or you might be an advisor working with clients, et cetera. Some of us, may either do some stuff either with the media or maybe you're running a company. The whole point is at each kind of spoke here, everyone's got a different incentive. There are some different biases. And I think just as we're on the investment side, just be really careful as you're pulling in all this data from different sources and thinking through, all right, who's got the bias? What's the angle? In Ashby's introduction, he mentioned that I used to be a healthcare analyst, so I spent a lot of time looking at that. So in healthcare, this company gets a brand new drug approved. So who approves it? The government. Is there any political pressure to get this drug approved or slow it down? You have to sort of think through that. It comes from a drug company. Are they trying to create a safe and effective drug, or are they trying to make money for shareholders, or both? You have to think through the different incentives there. The CEO, is he doing the best job for the company and investors, or does he want to keep his job? Reading sort of into statements and actions. The media, we could spend a whole day on that, but are they trying to tell investors in the world what's really happening, or is there an incentive to sell newspapers? And sort of digging through some of that, and it continues. You could look at experts. I think a lot of us, if you watch CNBC, talk to somebody who seems like they have a coherent story. Maybe that person is just very confident, as opposed to being a true expert, which in fact they probably would be behind the scenes at a hedge fund making multiples instead of just being on TV. So just kind of being cautious there, and I think the main thing is really kind of seek multiple sources of information, not just rely on one source. And you've got bias coming at you from different sources there. Okay, so we've talked about kind of in theory what behavioral finance is. We've gone through some different sort of personality types, talked about how different parts of the economy, there's different bias coming at you from different angles. So let's go into a case study. GEs. Anybody currently own GE or ever owned it in the past? Don't be ashamed. I owned it personally. Owned it up and down. It's quite all right. Could be interesting here. CEO used to be at Danaher, did a great job there, and he could have a turnaround. So one of the things, as I was kind of working through some of this behavioral finance stuff and thinking about putting something together for a book, we did own GE, and so we watched it start to blow up, and really I kind of lived through what I thought was some pretty nasty behavioral finance issues, and so I wanted to kind of encapsulate that here. So Jeff Immelt, he ran the company for about 17 years, did a pretty good job for the first few years, and unfortunately towards the end, whether it was his fault or the company's, just ran into some problems. 08, 09, had a bunch of these big financial liabilities. That was a problem. I think a big problem for them, they did this huge acquisition of the wrong company, wrong time, expensive, and they got over-levered, and things were really snowballing. And unfortunately, the CEO didn't fess up and say, guys, we're having a difficult time here. We're going to have to cut guidance. In fact, he did the opposite, and he said, we're going to earn $2 a share. At the time, I think the company was earning $1.50. So he said, we've got a lot of growth coming. I promise you, $2 a share. You can count on me. And this kind of, I talk about this a little bit in the book, but I don't know if anyone's seen this kind of silly 1980s movie, Better Off Dead. There's this newspaper boy who's out there, doesn't get paid, and he chases his customer around the entire movie. I want my $2. That kept coming back to me, strangely, because investors were literally chasing this company saying, I want my $2. And it was like, is this happening again? But I think really what happened here, the CEO, again, going back to that kind of web of bias, he had some issues there. I think he was keeping his job, thought he could paper over the problems. Investors got really complacent. And GE was a great stock for a long time. And I think investors said, you know what, I'm just going to trust the CEO. We're good. And I'm going to move on to other things instead of really going deep, really kind of pushing the envelope a little bit. And unfortunately, what happened was not very pretty. So things really, the wheels sort of fell off the bus. Here, this acquisition wasn't working out. They got into kind of gas turbines at the wrong time, and that product was falling apart. So just a little bit of inside baseball here. We owned it. This company split the stock, so you have to go back and reverse engineer it. But we owned it until kind of the mid to high teens, which felt awful. Had a lot of angry phone calls. That wasn't fun. I think for us, just as a quick kind of a case study, so that $2 goal, the company finally cut it and said, we're going to earn $1. And in year 2, Wall Street said, we think GE is going to go back to 20% growth. So despite all the problems, the turnaround's here, and they're going to grow 20%. And I couldn't believe it. I said, I'm sorry, that's not going to happen. And it ended up being like zero growth or slightly down. So we exited around 17. It felt awful. It felt like just, food poisoning or something. It was just brutal. And it went all the way down to below $7. So it was just not fun. It has turned around a little bit, but so this is an extreme case. Unfortunately, you do see these things happening once in a while. These massive blowups. Facebook's not looking that great. Netflix is not looking that great. So they do happen. Fortunately, they're generally outliers, but I think a lot of times there's a lot of complacency that kind of feeds into what investors are looking at. You'll have to push back against that. Okay, so. What else could go wrong? We talked about GE having some problems. This is a total eye test, so please don't try to hurt your vision or anything here. The whole point is, as I was kind of going through thinking about, okay, there's some really smart Nobel Prize winners out there. How can I leverage some of their ideas and use it in my day job? I created this checklist. This is pretty clunky and hard to use. I do like movies, kind of silly movies. I've got kids. We're watching Iron Man the other week, and Iron Man 1, he comes out with this big, kind of clunky suit, doesn't work that well. This is kind of the big clunky version of behavioral finance. Throw all the tools on one piece of paper and hope that something works. Again, I decided to take this and expand it and put that into really more of a reference. So for kind of every stage where you're working through a problem, there could be a behavioral finance kind of pitfall in front of you. For me, just this is still pinned on my wall, but it's kind of, okay, now let me remind myself, what, am I just trading this stock? Am I looking at it? Have I owned it for a long time? Kind of go and have a reference to think through what are some ways to try to avoid some of those problems. So I'm not going to torture you and go through all 100 of those things. That would be quite painful. So you're a very nice group down here. We're in Richmond. If I was back in D.C. with a bunch of tight-fisted people, maybe I'd push through and do all 100 and just beat them up. But I'm going to be nice today, so this is great. So we'll go through just 4 steps and kind of 4 quick things and go from there. So as you're thinking through an investment, again, it could be an individual stock, it could be venture capital, it could be an ETF you're looking at. I think a lot of times to do some initial research, pick up the phone, call the manager, look at a competitor, do some of that sort of thing, some initial research. The problem I think a lot of investors have is a confirmation bias. So a lot of times, instead of starting with a blank piece of paper, you say, well, I'm underweight tech, and I really got to buy some tech, so let me go find what's out there. And you sort of jump to that conclusion. When you might say, you know what, I'm just going to start bottoms up, look for some good ideas, see what's out there. Pivot to movies. I think that's a good way of reminding us that this stuff happens in the real world. Zero Dark 30, again, the hunt for Osama bin Laden. Not sure if anyone's seen it. Pretty intense movie. There's a scene in there where the woman at CIA, who's kind of critical to the whole film, is telling her whole team, guys, you've got confirmation bias here. You want to find bin Laden. You think he's there. You're taking all the data points and pointing them there, but you're wrong. You have to start over, and she kind of reevaluated things. They were able to find him, but it was really confirmation bias. And to me, that can happen in investing. You sort of want to go from A to B, and you can feel it, and you can taste it, and you just sort of make that leap, and you just pull in whatever data points can set that. So again, a good way to push back here is seek some outside opinions. If you feel like you're maybe kind of pushing a little bit too hard on something, talk to a teammate, play devil's advocate, seek some outside sources, and that's a good way to push back against that. All right, so let's say you're out there, you did your research, and you're ready to go. You have an investment thesis, maybe you have a price target, and it's time to pull the trigger. Now, a lot of times as humans, go back to Homer Simpson versus Spock, we get a little nervous. So markets kind of falling, maybe I'll wait a little bit, or markets, you're running, I'm gonna give it some time. Unfortunately, if we keep procrastinating, we're not really helping clients. We're not really kind of doing what we should be doing. We kind of set a target and go for it. But that's something that can bleed into that. One of the things that I've got a list of some books towards the back, but there's a book called Mindset, just some different ways of thinking through ways to kind of work through some of these issues. One, if you feel like, gosh, I have good ideas, but I always buy it too late, or I always buy it a few weeks after, sort of this idea of make concrete plans. So this woman wrote this book, Mindset. It's this idea of, instead of saying, yeah, I'm going to buy it at my meeting next week, you can say, I'm going to buy it on Tuesday afternoon at 3 o'clock in my committee meeting with my 3 partners. And you said, okay, you kind of set that in your mind, and that kind of sets a nice benchmark. You're much more likely to actually pull the trigger and make that purchase. All right, so we've done our research, we've bought the stock, and guess what happens? It goes down. Or has something crazy. Typically, that's kind of that can happen after you make a purchase. Something unusual happens. So another piece here of, again, as you're thinking through different investments you might have, working through that life cycle, ups and downs. Nothing goes in a straight line. One of the things that I've kind of looked at is, in particular, after you initially buy something, if it has some unexpected move, you might just say, wait a minute. I'm frustrated, I'm embarrassed, I just bought this thing, now it's down, and you kind of brush everything to the side, and you just focus on that one stock that might be down. The behavioral finance theme there is called a focusing illusion. It's almost like you're looking at one thing, you can't look at anything else. Unfortunately, that can be a problem, because let's say you're managing a portfolio with 50 investments, one's a problem, you've spent all your time on that one, what about the other 49? And so I think that's something where really you have to take a deep breath, push back, do a little bit more work, kind of broaden out the horizon, look at some other investments. Maybe something else is what you should be focusing on, not the stock that's blowing up, but again, just something to think about there. All right, and so we'll wrap up kind of towards the end of the investment life cycle. You did your research, you bought the stock, you traded it up and down a little bit. Now your original investment thesis, the reason you went into that asset class or that stock is kind of towards the end. The problem is, how do you sell it? I think a lot of folks hold on to things a little bit too long. There's a theme called a bias called the endowment effect, which is basically kind of the personal stories that we attach to an asset kind of cloud our thinking. And you can think of a home that's been in the family, or jewelry or something like that. And I don't want you to think I'm like a robot and have no feelings. Yes, I have feelings, so there's that. But I think for what we do for investing, these are frankly commodities. If it's a stock or if an ETF, and you really need to think about how do I value what I've owned for a while versus other alternatives that are out there. And so one of the ways of doing that is to, again, pull in some outside sources, just do some analysis, think about, frankly, the literature would say pervasive market forces. In other words, it doesn't really matter what I think or what my story is with this stock or this asset. It's what the market, what's happening in the market, competition, competitors, suppliers, that sort of thing. So really hit pause, look at some other alternatives to your stock. If other ones look more compelling, you make the switch. Okay, so we've done a quick kind of one-on-one of behavioral finance, thinking through how that can help you in your investment process. I mentioned at the beginning there are a few kind of new themes that are coming out. I don't know if this stuff is in the CFA literature yet, but I think it will be at some point. This can get a little bit tricky, so I'm going to try to handle it at a high level. But so Kahneman, who put out this Thinking Fast and Slow, again, kind of big part of the field, put out a book, just came out last year. And I really haven't heard a whole lot of people talking about it. It kind of goes maybe one step deeper in terms of behavioral finance. So I think this is maybe a little more relevant for teams. You've got a lot of teams working on a project, but it can be also maybe with yourself. So the idea here is basically everything we've talked about is bias. And so let's imagine you're playing darts. The goal of the competition is just hit the bullseye every time. This would be perfect, no bias, no error. You're doing everything correctly. Everything we've talked about today has been category B, which is, for example, all humans kind of have the same bias. Let's say we all have risk aversion or loss aversion. And for example, if I said, here's a bet, you have a 50-50 chance of winning $2 or losing $1, most people won't take that bet. That's actually a great bet. Statistically, you're more likely to come out, but most people don't take it. That's a bias that almost everyone has. So you could say, in general, people are going to be risk averse, or they're going to just miss the bullseye. They're going to miss the correct sort of answer pretty consistently. This whole idea of noise breaks that down and says, let's kind of go back to darts for the moment. The idea is, well, actually, left-handed people always do this, and right-handed people always miss the target by that. Doesn't seem too surprising. And then he goes deeper and says, well, actually, left-handed people in a good mood do it like this, and left-handed people in a bad mood do it like that. Right-handed people. So you have to take it down a couple notches. But anyway, so there's some interesting things there. But again, I think if you work in big groups, the idea is you may have folks who are really into growth stocks or tech or whatever. Maybe there's a bias there, and maybe some folks that really like value, and that's fine. But just think through. People have different kinds of bias, and that can kind of feed back into the ultimate result. So a little bit of some tricky kind of themes there, but I think it's something that may be helpful for folks looking into working in groups in particular. So we'll wrap up here. I think just sort of thinking through again, there's a lot of themes out there, but just in terms of something to take away, one thing I would hope, if there's maybe one or two biases or themes that kind of struck you, take that back to the office and say, wow, complacency, man, I got to think about that, or risk aversion, or whether it's endowment effect, that's something I got to work on, but really kind of problem finding instead of saying, okay, I got this, I'm just going to go solve the problem. This is great. Really kind of flip that around and say, what are the problems? What should I be looking at? What questions should I be asking? So that's helpful. The other piece is kind of quality versus quantity. So if we go back to the two different Coach Ks, different ways to be successful, and I think the question is, do you want to have maybe, if that emotional stuff is really challenging for you or for your team, maybe think of Coach K at Duke and kind of bringing that down, a little more strategy, a little bit less emotion that can help you in terms of, you can still have pretty good performance, but just a different kind of quality there. Bias and emotion, again, I think that's a big theme for us as individuals, for people you're working with, for clients, really kind of get a sense of that. And I think kind of could something lead you down a path. A smart person once told me, if you're hungry, angry, lonely, or tired, you're probably going to make a mistake. So just kind of, what mood are you in at that moment? Are you about to, pull the trigger on a big investment? Okay, stop and think. Hang on a second. Am I in a good mood here? Am I going to rush into something? Last couple things, baby steps. So I'm kind of thinking back to March of 2020. Pretty brutal time. Clients are calling in. Markets are going straight down. What do you do? No right or wrong answers, really. But I think at that moment, for us, we just said, okay, emotions are really high. We're not going to pull everything out. We're not going to go all into one particular sector. We're going to take some baby steps. And that's what we ended up doing. I think that helps you limit regret, whether you're right or wrong. But I think that's something you can do for behavioral finance, is just take some incremental steps. And then last piece to leave it off, growth mindset. So for example, going back to GE, that was a very difficult investment for us, pretty brutal, didn't feel good. But I think the idea is, instead of looking backwards and saying, oh, I lost so much money, this was difficult, that's sort of a fixed mindset. I'm going to look ahead and take a growth mindset. What did I learn? What can I avoid next time? And kind of help that for the process. So that's a quick run through. I'll be happy to take questions, and I've got a couple sources here for other reading and that sort of thing. But appreciate everybody's time, and happy to answer any questions. Yes.
I've got a question. I'd like to hear your comments about implementing limits and stop losses to take some of the emotion out of investing.
Yeah, that's a great point. So limits and stop losses, that sort of thing. I think it can be helpful. I think I guess what I would say is consistency. So if you have an investment process and you normally use things like that, stick with it. That's probably a good thing to do. What I would be careful with is if you don't use that. So for example, we don't use a whole lot of that. Be careful saying, okay, you know what? I think I'm going to make a really big move. I'm going to put a stop loss in. I got this. And things might not work out. So I would say, if you're thinking of doing something like that, ease into it. But if you are doing it, I think that is certainly a way to limit some of that volatility, and kind of, you put a line in the sand and say, this is where I'm cutting things off. So it's a good point. Yep. Yes.
How would you think about applying this to evaluating management teams? Because I'm thinking with GE obviously buying billions of dollars of stock,
Right.
their cash, the airlines, Macy's,
Yeah.
other companies, also all the CEOs chasing the stock price, using
Yeah.
that, which they all wish they had it.
Yeah.
So can you apply this to kind of your evaluation?
Absolutely. No, it's a great question. I did a little bit of this a long time ago. I worked for a company called Cambridge Associates, and they evaluate managers, that sort of thing. I think, so I'm not a specialist now, but I'll give a couple of tips. And I think the main thing is, be careful assuming the future is going to be like the past. And I know there's a lot of chasing the hot dot and that sort of thing, but really evaluate each manager on their own, and just don't go in with that assumption that great track record might not necessarily continue rolling forward. I know there's a lot of literature that would suggest that, but again, I think that avoiding complacency, avoiding saying, oh, check the box, this team's got it, and really just taking a broader view of different managers that are out there. So not a perfect answer for you, but I think just do all the due diligence you normally would do, but I really just use analysis as much as you can, and avoid getting kind of trapped into that idea of complacency. Probably the best approach. Good question. Yes?
I feel like we talked around this and maybe touched it a little bit, that gentleman's last question, but
Yep.
just kind of a little bit on the value or thoughts on incentives, right?
Yeah.
I mean, like, back to the GE example,
Right,
I
right.
don't think, I think most people would not think that Jeff Immelt was lying, right?
Right.
He was highly incented to
Yeah.
draw that, and so he almost was,
Right.
kind of blinded
Yeah.
by that. Just
Yeah.
talk about,
Yeah.
the role of incentives in these types of.
Absolutely. So incentives are a big deal. I think in some ways that feeds directly into actions. So kind of those desires and the actions, those are linked. I think for us, practically, I think looking at corporate governance, if you can use something like that as a part of your regular investment process. And people talk about ESG, but some investors would say, well, the G is part of every investment process. Look at that. Look at the proxy. Look at the incentives. And I think it's critical. If a CEO is paid on sales growth, you're asking for trouble. He's going to do the big deal. He's going to, that sort of thing. So as much as you can find metrics that you think are good incentives, ROIC or something like that.
If I could
Yeah, please.
I'm thinking more almost like psychologically. I mean,
Sure.
of course, financial incentives are key. But
Absolutely.
you know, this kind of, hey, let's do
Yeah.
action.
Yeah.
And you know, I looked
Right.
at your book, and I'm like, the word
Right.
that sticks out to me the most is stop.
Yeah.
Like,
Yeah.
not
Yep.
invest. It's
Yeah. Yeah.
probably more of the stuff we don't do that.
Yeah. No, it's a fair point. Yeah, I think I finished the book saying the hardest part is to stop because we're all so busy, we're multitasking. That's why this thing is like for busy investors. We just go, 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 and we don't stop, and that is one of the hardest things. I think applying that back to management teams, it can be tricky. I mean, you've got Elon Musk on one hand doing everything in the world. I mean, at least one of those businesses is pretty successful up until now, and I don't know what's going to happen with Twitter, et cetera. But what are his incentives? You know, if you're a Tesla shareholder, is his brain 100% focused on Tesla, or is it something else? And the market would say no a couple days ago. But no, I think it's a fair point. I mean, I know there are services that go really deep on these managers and, you know, kind of you can screen through the earnings conference calls and tease out language. And so you can really go deep there. But I think at a minimum, the financial stuff to me is pretty critical because then you can put everyone on the same page and kind of look at that. But certainly patterns are pretty important. So good question. Yes.
Thanks for your talk.
Yeah.
So I work at CFA Institute, and we're doing some work thinking about social validation investing.
Okay.
And,
Okay.
and gamification. So
Okay.
all the different nudges being used
Yeah.
in apps
Yep.
and so forth.
Yep.
And one thing we found was that people are very, very prone to follow the nudge.
Yeah.
Get a push notification.
Yep.
People think it's in their best interest. But
Yeah.
anyways,
Yep.
we're doing some consultations
Okay.
around
Okay.
that. And I'm curious if you have views on good and bad nudges.
Ooh. Yeah, it's kind of a sore topic there, but it's good because I think you can use that. You can use them in different ways. You got to be very careful. And so yeah, the book Nudge kind of talks all about that. But yeah, I think there's one of the themes I talk about is in the book is kind of I think it's libertarianism, but it's sort of a paternal libertarianism. That's like, what does that mean? But it's this idea of if you're running a company or a government or something, do you have the ability to be paternal and sort of, this is what's right for you, but also libertarian? In other words, kind of create a free market. So like if you're saving for retirement, you have to opt out. That's probably good for that person judged by themselves. So I think if you can do that, that's probably the feedback loop, but you gotta be very careful with that, yeah, because the incentives, if you do it wrong, it can lead you down the wrong path. But good question. Yeah. Other questions? So, great. So yeah, these are a few kind of sources. We can maybe send the slides around, but a few of these are a little bit thicker reads. The one, just for what it's worth, if folks are into podcasts, the one down here, this Freakonomics one, it's actually Michael Lewis kind of giving his 5 or 10 minute review of what he thinks kind of this field. It's a pretty quick listen, but it's a lot of different things to think about. So, great. All right. Thank you very much. Appreciate it.